Well, hello. My name is Tsipas, a director at RSM Financial Services. And today I have with me special guest, portfolio manager and founder of Antipodes Partners, Jacob Mitchell. Welcome, Jacob. Thanks for joining us today.
Evan, it's great to be here.
Great. Before we touch on the investment performance of your fund, Jacob, can you describe your role as portfolio manager and touch on what makes your investment process unique and expand on your philosophy?
As the portfolio manager, effectively I'm the lead PM on the Antipodes Global Fund and the Antipodes Global Fund Long. Look, our approach to managing money is really just to find not just great companies, but great companies at attractive valuations, no matter where they are in the world. And then often we find, more than one opportunity, and we like to build portfolios from clusters, which are, just companies which have got a similar, we would argue they're cheap for the same reason, because often, cheapness doesn't happen because everything's perfect. It's because the market's becoming irrational around some sort of change. It may be a cyclical change facing the company, a structural change. But when that happens, often you get a company that trades at a discount to intrinsic value. And in our research process, I lead a team of over 25 investment professionals, and we organize those team members around sectors. And we, each of them are experts. Each of our 5 sector teams are really experts in a particular part of the market. And so they're looking for those types of opportunities in that market, and we'll build up a cluster over time. And that keeps the research process highly productive. And it also gives us an opportunity to manage risk. We're really looking for non-correlated clusters of opportunity. It's a bit of a mouthful, but we're looking for basically groups of companies that are cheap, but they're not all going to behave in the same way. So when you get, sort of a volatility in markets, similar to what we've just experienced, the portfolio itself behaves in a less volatile manner. And, we can also short, which, obviously we're looking for weaker companies that are overvalued as a part of that process. That's the real nuts and bolts of the core of what we do. We do believe currency management is another way that we can generate alpha, and we think it's a necessary part of understanding the risks around the companies that we own. But it's a pragmatic value approach.
Jacob, your flagship global fund, the Antipodes Global Fund, has outperformed its benchmark since inception. For a little while it lagged the benchmark, and again over the course of this year, you're outperforming again. Leading into 2020, it has been hard for value-conscious investors to keep up with a market that rewarded companies that are growing revenue rapidly, but not necessarily profitability. Can you touch on what's driven your outperformance this year? Perhaps what you found challenging about the investment climate leading into February 2020, and how likely it is that we are witnessing the birth of a new bull market?
Yeah, look, they're good observations. I might start with the middle one and really just the environment of 2019. As you point out, it was those companies with good top line growth that outperformed. Generally, what we describe as at Antipodes, at least, we call it the duration bubble. Long investors looking at longer duration assets. Now, that doesn't really talk to what the nature of the business is. It's this concept that when real rates collapse to zero or below zero, investors are willing to pay a higher price for those companies that have their cash flow further in the future. And they tend to become much more sensitive, or they become the outperformers. And that's certainly gone to an extreme when we look at all the quantitative measures of what the market's paying for. Let's call it high growth versus low growth, or high valuation versus low valuation. You are getting to sort of generational type extremes. So we think it's a function of low real rates, and which are a reflection of maybe a lower growth environment. And there's, we can go into sort of lots of underlying reasons for that. But probably it's a question of how long does that last? And then in the beginning of this year, we had a very different type of, let's call it crisis, more of a health crisis, and it really leading to a very correlated sell-off in the market. So investors, the first thing they do when they start to see the economy being shut down is ultimately, is sell everything. So growth, value, quality, high quality, low quality, didn't really matter what style, what sector, what region. The initial response was sell everything. And the Antipodes Global Fund, we had some downside, we had some protection in place in terms of shorts on, and the cyclical shorts, especially anything related to aerospace or industrial cyclicals, those shorts paid off well. Also, we were short businesses with relatively weak balance sheets. As we describe it, multiple ways of losing. One of those ways is just weaker financial, weaker companies in weaker financial positions, and so those two clusters of shorts paid off handsomely. We had some credit protection as well, because we are concerned about the longer term sustainability of corporate credit. We're an equity investor, but when you buy an equity, there's also always the business, your exposure to how a business is being financed is a critical part of that assessment. And we're genuinely concerned by some of the behavior in the past, since the financial crisis, in terms of companies that have geared up to do buybacks and taken on a lot of leverage in industries which are under disruptive pressures from some of the large tech companies. And then finally, in the long book, our long investments, look, it's been let's call it the defensive part of the portfolio that gave us the most protection. So we have a cluster of pharmaceutical stocks as being the cheap defensives in a world where defensives are generally very expensive, that arguably they are the cheapest part of that market. And we think there's good idiosyncratic reasons to own them, i.e. we don't think they're as bad. Like, these are stocks, you can buy Merck or Roche, relatively boring businesses, but still growing at 7 to 8% per annum on P's of 12 and 13, 12 months ago. If those companies were selling toothpaste, they'd be on P's of 24 times. So, we thought, that's oversimplifying our case, but just to illustrate that we thought they were very, from a pragmatic value perspective, quite cheap. So that cluster did very well. And the internet stocks, now you might think, well, that's a bit strange. You own, you've got a big cluster of internet stocks. Well, coming into this, companies like Facebook, or software companies like Microsoft, they weren't, we think, expensive for the growth that they were generating, and they've proven to be quite resilient, business models. And our Chinese versions of those companies, like Alibaba, similarly have behaved quite defensively. And ironically, COVID has given them tailwinds. And you could argue in some of the healthcare exposures we've had, we've also gained tailwinds from COVID-19. Now, the bad news, some of the more cyclical parts of the portfolio obviously have underperformed. They were cheap coming into this. They were somewhat already priced for a recession, and they've gotten cheaper in this big, unwind of value. And that's the interesting thing about this year. In some ways, it's just a continuation of last year, but with more volatility. Investors continue to crowd into momentum, growth, high PE, and are not really interested in more cyclical parts of the market. They just keep getting cheaper.
Jacob, in many ways, we're not operating in a free market, are we? Perhaps, the proof is in the unprecedented monetary and fiscal stimulus that authorities can apply. we may successfully mitigate what could be a deflationary bust here. Short-term deflationary forces seem to dominate as the economy is in hibernation. Do you see anything worse than a severe recession ahead? Your cash position indicates you are exercising some caution.
Look, we are cautious. I mean, there's lots of unknowns around COVID-19. Probably the biggest one is simply the degree of asymptomatic infection in the community, i.e. infections that we're not picking up, and also the degree of any immunity. And until we have more information around that, it's hard to make a judgment on the necessary duration of lockdown. Governments have been very proactive on the fiscal front, and if you thinking about things that have changed, if you think about the decade leading up to this crisis, we had monetary policy without a lot of fiscal stimulus. And Antipodes has been really pushing this framework of populism will ultimately lead to fiscal stimulus. Well, we got there. We did get there, but probably not the pathway that we expected. So we've got now we have, let's call it, proactive monetary and fiscal stimulus, and the hit to unemployment so far has been much larger than the hit to income. Right, because in the US, where you've got, we're at 15% unemployment, 20 million people getting benefits. That benefit has been increased by $600 a week, right? So the unemployment benefit in the US is running now at roughly $50,000 a year. So now COVID-19 has hit some of the lowest income groups. It's very sad what's happening. I mean, in terms of hospitality, travel, these are not high income. Now the government is paying them a supplement. So in some cases, the statistic I saw, which was amazing, was that something like of households that are earning less than 40,000 a year, more than some 40% of people have lost their jobs. Now they are going on to benefits that are potentially higher than what they were being paid. So we're getting some offset. The US has sort of effectively embraced a social wage, in their response to COVID-19. Now that comes at a cost, and just so your listeners can work out the maths, the way we think about it is that for 20 million people unemployed, that additional $600 a week that they're getting is costing roughly 25 basis points of GDP per month. So just under 3% of GDP per year. Now, the interesting thing is we're coming up to an election, and you can imagine the Democrats especially are going to be, it's going to be difficult for politicians to take this benefit away. And maybe they shouldn't until there's some sort of sustainable recovery in place. So lots of unknowns. What we do know is that we've got massive fiscal work trying to offset the worst of the demand shock through income protection. And I think in terms of our framework for investing we're looking 2 years ahead, 3 years ahead. Our investment horizon is, really it's a 3 to 5 year investment horizon. What we're thinking about this in stage 1, stage 2 dynamic. Stage 1 are the companies that benefit, without being sounding. Obviously, we're very conscious of how serious this is, but there's companies that are actually getting tailwinds, as we discussed. Internet, pharma, they are somewhat getting tailwinds. Those stocks, to the extent they're not expensive, I suspect are going to continue to perform okay. It's then thinking about the areas of the market where there's been massive dislocation and thinking about the companies that are going to come out stronger as stage 2 beneficiaries as the economies start to open up. And you will never get the timing perfect, but if you're buying the business at an extraordinarily cheap valuation, you are getting a margin of safety around that timing. And that's our framework for navigating this area. Do we get to an inflationary environment? Very, very hard to know. maybe the thing to think about is some of the tailwinds, the deflationary biases that have been in place, which have been outsourcing to cheap labour markets. One response of governments to COVID-19 will be to bring supply chains closer to home. So I think that's inflationary, ultimately. The income stimulus, to the extent that recovery starts to get traction, is ultimately, could end up being somewhat inflationary. Demographics, most people say, well, older generation, that's inherently deflationary. Well, if you think about it, you've got fewer people working for, as you have more people retiring, the residual labor force is actually getting more bargaining power. Now, it's hard to visualize that given how big the unemployment numbers are. But, if you bring supply chains home, if at the same time you're paying a social wage, which is actually ultimately discouraging people from going back to work, you actually may get some very weird outcomes in terms of some sort of wage pressures over time. But it really so sensitive to the way we come out of COVID. So too hard to know, but I certainly would be keeping an eye out for those, monitoring those types of trends, supply chain localization, the extent that a social wage gets embedded in the system, and just the, ultimately the COVID specific issues of, herd immunity and the speed at which we open up the economy. Those three things, I think, are going to be your measuring stick for, the potential for a change, from the deflation disinflation to more inflation.
It's almost a definitional outcome. If you produce a lot less and you supply a lot more money for a given amount of services and goods, at some point in the future, inflation could rear its ugly head. But I guess from your answer, it's such a complex evolving piece that, my only conclusion is that you must be heavily diversified across a couple of these potential outcomes.
I think that's right. And, the way we describe that at Antipodes, I talked about stage 1, stage 2 type beneficiary, or types of investments. The other way of thinking about it is we call it the barbell approach, because you've got this massive, very, very high P dispersion. On one hand, you have companies like a Shopify that don't have much in the way of earnings, but are trading on a massive multiple of revenue. And at the other end, you can buy, let's call it a boring telecommunications company on a 5% dividend yield, on a low multiple of earnings. So you're giving this extreme range of valuations, and it's truly extreme. Like, it's actually, you're talking about 99th, 100th percentile type environment. As a pragmatic value manager, sometimes I'm surprised we have any. It's been, because it has been such a headwind, just that dynamic for our natural style. Even if even to the extent you're trying to be relatively style neutral, the danger is that neutral becomes is quite extreme. The benchmark can become quite extreme, and therefore being neutral is also quite dangerous. So at the moment, we have a skew against some of that high multiple and part of the market, and it's a bit painful, but I think ultimately we'll get paid for taking that position. Our investors and our shareholders will get ultimately, it will be worth staying the course. But the barbell is basically that idea that not all of these low P stocks are secular losers, and it's picking through them for those companies that have businesses that are going to be relevant to in 5 years' time, 10 years' time. And then at the other end, it's not closing your mind to some of the higher PE stocks. It's actually, a lot of that structural changes we want to benefit from. And we've held Microsoft from in the inception of the fund, and we still love it because we think it's undervalued for as its a business has evolved. We think the market has lagged the transformation that's taking place. The market's valuation of Microsoft has lagged the underlying transformation of the business as it goes to cloud, and its SaaS offering, its software as a service, its Microsoft, Office 365. They just mesh so well together, and it has such a low cost distribution model for software. Because that's what kills software margins. It's not, they're high gross profit businesses, but show me one, why doesn't Zoom or Slack or Shopify, why don't they have profits? It's the cost of selling it. Anyway, that's the barbell is, I think, what will work in this environment, and that's how when we do the opposite in the short book, we're looking for some of the irrationally expensive stuff that isn't really what people think it is, and then at the other end, we've got some low P shorts because we think they're cyclical businesses that have serious secular headwinds, which is the opposite of what we're looking for in our cyclicals. We're looking for companies that are actually secular winners that people think are cyclical, if that makes sense.
Jacob, I might run through some of your more familiar holdings. Microsoft, Facebook, Alibaba, Merck, Samsung, names many Australian investors are familiar with. I might just touch on one, Siemens, which is certainly known to Australians, but perhaps less so. It trades, and I just had a superficial look, Jacob, at a PE of 12.5 times earnings, or an earnings yield of about 8%. So it appears cheap. I guess my question is, and to gain an insight into your thinking, the market must be concerned about something, surely. And so how do you see this business, and what do you feel is being underappreciated by the market?
Yeah, look, I think, Siemens, when you think about how the business portfolio has evolved, I think the market has lagged the understanding of what's, just the slowly unbundling, or, it's been always a fairly diverse portfolio of businesses, but over time they've built more and more concentration in what they describe as the digital factory. So roughly half of the profits now are attributable to a software and hardware business, which goes hand in hand. It's an automation business, but that probably undersells it, because what Siemens can do is on your software, that you can design a computer chip, you can design a car, you can create a digital twin, and then you can also manage the manufacturing of that product. So let's call it, it's PLM, product life cycle management. Now that's very clever stuff, and like great software businesses, once you're embedded in the company, the manufacturer, it's very hard to get them out. It's a little bit like an SAP installation. And then, that obviously gives them pricing power, sticky customer base, all the things we like in what the market likes today. And, why is it willing to put Microsoft on a high PE? Because it sees the subscription nature of that relationship, and the fact that it's very sticky. So it believes it's a long duration cash flow. So we see those characteristics in Siemens software business. The hardware business is going to be a little bit more economically sensitive, but this is not boring commoditized hardware. They have a very good position. The software has to talk to hardware once you to manage the manufacturing process. So that makes them fairly unique. Most of their competitors aren't able to do both. They do the hardware or do the software, but they're not doing the integrated solution. So the other parts of the business, Siemens attracts some negative headlines around it sometimes, but it's actually a relatively green portfolio. So they manufacture wind turbines. They do gas turbines. the exposure they have to other sorts of thermal generation are relatively low. And those businesses are being spun out together, and they also have all of the clever stuff that allows your electricity grid to work. So all the grid management, and when we look at some of the stage 2 beneficiaries, we think they're going to be governments have to move from income protection to job creation, and job creation is going to be about, I think, investment, infrastructure. In Europe, it's probably going to be related to decarbonisation. So we're starting to think about, well, what companies are going to actually get the benefit of that spend? And Siemens is effectively a ready-made beneficiary of, I think, a big decarbonisation cycle that will emerge in Europe. Europe doesn't have much in its toolkit when it comes to, it's stimulating, but I think they'll go all in at some point on a major investment cycle, similar to what the US did in response to the Great Depression. You had the New Deal, and after the war, Second World War, you had the Marshall Plan. I think something like similar to that's coming in Europe, and you want to be thinking about your positioning today.
Oh, that's good. So I guess it could, in many ways, it's reflective of your multiple ways of winning just within one stock. I guess it has a lot of strings to its bow.
Yeah, absolutely.
The clients at RSM, 28 financial advisors, and our broader network, we thank you for taking the time today to speak to us. I'm wishing you the best for 2020. And just a note for our listeners, today's content is for education purposes. If you are seeking investment advice that is personal, please reach out to your local RSM advisor. And once again, thank you, Jacob Mitchell from Antipodes. Until we speak again.
Great. Thanks, Evan. And thanks to RSM for the opportunity.